Welcome to the Deep Dive, where we take all the complex research, all the data, and we boil it down into the insights you actually need. Today, we're tackling a fascinating one, a giant in the software world. Adobe, ticker ADBE.
And this is such an important story right now because Adobe isn't just, some big software company. It's historically one of the most resilient, most profitable franchises in all of tech.
You have to remember, they pulled off what seemed impossible about a decade ago under their CEO, Shantanu Narayan.
Oh, that pivot was legendary, from selling, software in a box to a subscription model. Sauces. It was a masterclass.
And here we go again. It feels like history is rhyming. Now they're facing another massive challenge, another inflection point with generative AI. It threatens the very core of what they do.
It really does. But here's the paradox, and this is really the core of what we're unpacking today. The company itself is a financial fortress. The margins, the cash flow, they're incredible.
But the market is treating the stock like the whole business model is about to fall apart.
That is the disconnect. I mean, look at the numbers. The stock's trading at a PE multiple of, around 20.7 times earnings?
And historically,
its 5-year average has been way up there, between 35 and 45 times earnings. So this massive derating of the stock.
it's like the market is saying Adobe is done growing.
Exactly. It's being priced like a mature utility with, a capped value. The bear case is basically pricing in zero long-term growth.
So that's our mission for this deep dive. We're going to use the absolute latest financials. We've got the Q4 and full fiscal year 2025 results right here. And we're going to combine that with a deep look at their AI strategy to really test that pessimistic view.
Is the market right, or has it just fundamentally mispriced one of the highest quality compounders in the entire tech sector?
Let's find out. And to really get it, you have to start with the foundation they've built. It's nearly unbreakable.
You really do. To understand why the valuation seems so off, you have to appreciate the sheer quality and durability of this business. And it all goes back to that strategic shift a decade ago.
Let's talk about that for a second. That cloud transformation. I remember at the time, people were furious.
Oh, there's panic.
Going from buying Photoshop once for, say, $1,000 and owning it forever, to suddenly being forced onto a monthly subscription. It felt like a cash grab, a huge risk.
It did, but man, did it pay off. That shift to the SaaS model means that today, over 95% of Adobe's revenue is recurring.
What's the bedrock?
It is. It gives them this incredible visibility into their future cash flows. Management knows, with a pretty high degree of certainty, what they're going to earn not just next quarter, but a year from now. Customers are locked in.
And that predictability lets them do something really powerful financially, something called negative working capital. For anyone who hasn't heard that term, can you break down why that's such a huge advantage?
It's really the hallmark of an elite subscription business. It's actually a simple concept. So working capital is just the difference between your current assets and your liabilities. Most companies have positive working capital.
Right, they spend money on stuff before they get paid for it.
Yeah, exactly. They build inventory, they provide a service, then they send an invoice. Adobe's is negative. And that's because customers, whether you're a photographer paying $50 a month or a Hollywood studio paying millions, they pay up front for their subscriptions.
They get the cash before they even deliver the full service.
That's it. Adobe is basically using billions of dollars of their customers' cash to fund their own operations, their R&D, their buybacks. It's like getting an enormous interest-free loan from your entire customer base.
It's an incredible financial engine.
Very few businesses have that kind of advantage.
And that predictable flood of cash is then channeled into what Adobe calls its 3 strategic clouds. This is the structure of the empire.
Right. So first you've got the most famous one, the Creative Cloud, or CC. This is the crown jewel.
Photoshop, Illustrator, Premiere Pro, all the big names.
All of them. And the strategy here has evolved. It's not just about selling tools anymore. It's about becoming a full creativity platform. That means collaboration features, integrating their stock photo library, and now, of course, embedding generative AI right into the workflow.
They want to own the whole process, from the first idea to the final product.
From idea to asset. Then you have the workhorse, the Document Cloud, DC.
Acrobat and Adobe Sign. Not as glamorous, but hugely profitable.
And absolutely critical to how modern businesses run. And that's the genius of it. It's a utility. It's all about digitizing paper, legal contracts, HR forms, finance approvals, e-signatures.
And once a big company builds its internal processes around Adobe Sign,
the cost of switching is enormous. It's not just a software cost. It's a process and compliance cost. It's incredibly sticky. It's its own kind of moat.
And that brings us to the third pillar, the Experience Cloud, or EC. the enterprise brain.
This is their suite for marketers. You've got Analytics, Marketo for marketing automation, Magento for e-commerce.
So this is designed to be the operating system for the chief marketing officer.
That's the perfect way to put it. Think about the whole workflow. A marketing team uses Creative Cloud to design a campaign. They use Document Cloud for the contracts with an agency, but Experience Cloud is what connects that creative work to the customer.
Delivery, measurement, personalization.
All of it. So they link creation with measurement, and that's something a competitor like Salesforce just can't do because they don't own that creative front end. It's a very powerful end-to-end story.
Which brings us back to that market skepticism. The big fear is that generative AI tools like Midjourney can just replicate the features, making the moat worthless. But you argue the moat isn't about features.
Not primarily. It's defined by two things that are much harder to copy: file format standardization and workflow entrenchment.
Okay, break that down. File format standardization.
Think about a professional design agency. Their entire world revolves around the .psd file, the Photoshop file. It's not just an image. It's got hundreds of layers, edits, masks, all this complex data.
Right.
If a new AI tool comes along and it can't open that PSD file and render every single layer perfectly, 100% perfectly, it's useless. It cannot be used in a professional collaborative workflow. The PSD file is the universal language of professional design.
And the workflow part is the human element, the muscle memory.
It's the cognitive switching cost, and it is massive. A video editor who has spent 20 years learning every keyboard shortcut in Premiere Pro, their productivity would plummet if they had to switch. You'd have to retrain everyone, rewrite all your standard operating procedures.
For a busy agency on a deadline, that's just not going to happen.
That lock-in is a much stronger moat than any single line of code.
And you see that durability reflected in their profitability, which is just elite. These numbers should command a much higher valuation than 20 times earnings.
Objectively, yes. The gross margin is consistently around 88 to 89%.
Which is just absurd. So for every dollar they bring in, 88 cents is left after the cost of providing the service.
It's the definition of operating leverage in software. The cost to serve one more customer is basically zero.
And they maintain that discipline further down the income statement too, even with all the heavy investment in AI.
That's the amazing part. Their operating margin on a non-GAAP basis is over 45%. Now, it's important we say non-GAAP here. GAAP margins include things like stock-based compensation.
Non-cash expenses.
Exactly. For a mature tech company like Adobe, non-GAAP is often a cleaner look at the core cash-generating power of the business. To maintain a 45% margin while spending billions on AI compute power, that shows incredible pricing power and operational discipline.
And the final number, the result of all that, is just a fire hose of cash.
A massive one. The free cash flow is estimated to be around $9.74 billion for fiscal year 2025. And that's the war chest. That's what funds the buybacks, pays for acquisitions, and protects them from any macro storm.
Okay, so that's the foundation, a high-quality, cash-gushing business. Now let's look at the reality on the ground. If the market thinks this is a zero-growth story, the latest data should show that, right?
It should, but it doesn't. They released their Q4 2025 results on December 10th, and they really flew in the face of that bearish narrative.
It was a classic beat and raise quarter.
It really was. The market was whispering about weakness from the Gen AI threat, but the numbers were strong. Total revenue for the quarter hit $6.19 billion. The consensus was looking for $6.11 billion.
And that's 10% year-over-year growth.
Let's just pause on that. 10% growth. For a company of this scale, it's not the 20% growth of the past, but it is absolutely not zero.
Not even close.
It shows that, yes, the law of large numbers applies, but they are still finding ways to grow the top line at a double-digit rate. And earnings were strong, too. Non-GAAP EPS was $5.50, beating the estimate of $5.40.
And they did it without sacrificing profitability, which, again, points to that pricing power.
That's the key. That 45.6% operating margin in Q4 proves they are managing the higher costs of AI. They're not having to slash prices to compete. They can hold that premium because what they offer is still essential for professionals.
So let's dive into the segments. Digital media first. This is the core engine, the part the bears think is most at risk.
Right. So digital media revenue was $4.62 billion, up 11% year over year. But the number you have to watch for any subscription business is annualized recurring revenue, ARR.
The leading indicator.
It is. Total digital media ARR grew to $19.20 billion. That's an increase of 11.5% from the year before.
So, if professionals were fleeing to cheaper AI tools, that number should be flat, or even going down. This number directly contradicts that thesis.
It completely refutes it. It shows the workflow lock-in is real. And what's more, the adoption of their own AI, Firefly features like generative fill and Photoshop, is actually a net positive.
Of keeping people in the ecosystem.
It's keeping them, and it's encouraging them to upgrade to higher-priced plans to get more of what they call generative credits. So AI is making the subscription more valuable, not obsolete.
What about the document cloud, the sleeper segment that always seems to overdeliver?
It continues to be the quiet superstar. It consistently grows faster than the rest of the company, often up in that 17–18% range.
And the driver there is expanding beyond just creatives, right?
Exactly. It's about targeting every knowledge worker. And the big new feature is the Acrobat AI assistant. Imagine you're a lawyer looking at a 300-page contract.
Right.
With this, you can just chat with the PDF. Ask it to summarize the key risks, find specific clauses. It turns a static document into a dynamic database.
That's a huge productivity boost.
It's massive, and it justifies a license for employees who would never, ever open Photoshop. It's a whole new avenue for growth.
And finally, the digital experience cloud, the enterprise piece. Growth was a little slower there at 9%.
Which is pretty typical for big enterprise sales cycles. But these customers are incredibly sticky. Once they're in, they're in. And the big new product here is GenStudio.
What is that?
It's an AI-first platform for creating marketing content at a huge scale. And it's doing incredibly well. It's already surpassed $1 billion in annual recurring revenue.
$1 billion in ARR for a brand new enterprise product is a massive win.
It is. It proves enterprises see the value in that end-to-end platform. They don't want 5 different vendors. They want one integrated, legally safe system. GenStudio gives them that.
So when the market is this pessimistic, I always look at what management is doing with its own money. That's the real signal of conviction.
And their actions could not be clearer. They see the stock price, bouncing around in that $320, $350 range in Q4, and they think it's a bargain.
How do we know?
2 things. First, record operating cash flow in Q4 of $3.16 billion. They are flush with cash. Second, they use that cash to aggressively buy back their own stock.
How aggressive are we talking?
They repurchased about 7.2 million shares in Q4. To put that in perspective, in Q4 of the prior year, it was 4.6 million. So that's a huge acceleration.
And they have authorization for more.
A lot more. A $25 billion share repurchase program that runs through 2028. This is management screaming from the rooftops that they believe their stock is cheap.
And their forward guidance for fiscal year 26 seems to back up this story of steady, predictable growth.
It does. They're guiding for revenue between $25.9 and $26.1 billion. That's about 9–10% growth. Again, the law of large numbers. But the key number in that guidance.
Let me guess. ARR.
ARR. They're targeting over 10% total AR growth. So even with all the headwinds, all the competition, they believe they can keep growing their recurring revenue base faster than the global economy. The data just doesn't line up with a zero growth valuation.
All right, let's pivot and focus entirely on that AI threat. I mean, this is the source of all the fear, right? How does a premium company like Adobe compete with tools like Midjourney that can make amazing images for next to nothing?
They knew they couldn't just build another image generator. They had to build something different, something that solved the biggest problem for big companies using AI.
Which is the legal risk.
The legal exposure, exactly. And that's the whole idea behind Firefly and what we're calling the ethical AI moat.
Okay, explain that. What's the difference?
Well, when models like Midjourney or Stable Diffusion were trained, they basically scraped the entire internet. That includes a lot of copyrighted material.
So if a company uses an image from one of those, they could get sued later for copyright infringement.
And for a Fortune 500 company, that's a non-starter. The risk is just too high. Firefly, on the other hand, was trained on a completely clean data set. It was all Adobe stock images, openly licensed content, and public domain stuff.
They know exactly where all the training data came from.
They have the receipts for everything. And because of that, they can offer something the others can't. IP indemnification.
Meaning, if a company like Nike uses a Firefly image in an ad and gets sued, Adobe steps in and takes the heat.
Adobe covers the legal costs and any damages. For a big enterprise, that commercial safety is a massive B2B moat. The value proposition is no longer make me a pretty picture, it's make me a legally safe picture. That's worth paying a premium for.
But running these AI models is incredibly expensive. All that computing power. How do they monetize it without just crushing their margins?
With a very clever system. They created the generative credit system. It's basically a usage-based model layered on top of the flat subscription fee.
So how does it work?
Every subscription plan comes with a certain number of credits per month. You use these credits for AI tasks like generative fill, but if you're a heavy user like a design agency, you'll burn through those credits pretty fast.
And then you have to buy more.
You either buy more credit packs or you upgrade to a more expensive subscription plan that comes with more credits. It's a brilliant way to directly link revenue to AI usage. It pays for the high compute costs and it incentivizes users to upgrade.
So that's the defense. But they also went on offense in late 2025, buying SEMrush for $1.9 billion in cash. SEMrush is an SEO company. It seems like an odd fit.
At first glance, maybe. But it's actually a visionary move to future-proof their Experience Cloud. It's all about where the world of search is going. We're moving from SEO, search engine optimization, to something new. GEO. Generative Engine Optimization. Think about it. People aren't just typing keywords into Google anymore. They're asking complex questions to AI chatbots like ChatGPT or Perplexity.
And those chatbots synthesize answers from all over the web.
Exactly. So for a brand, the new challenge isn't just ranking on Google, it's making sure your content is what the AI chatbots find, trust, and use to create their answers.
So SEMrush gives them the data to figure out how to do that.
It gives them the intelligence layer. SEMrush can see what questions people are asking the AIs, and this allows Adobe to offer a complete end-to-end workflow for enterprise marketing, the entire content supply chain.
Walk me through that chain.
Okay. Step 1, SEMrush tells you what topics are trending and what questions people are asking. Step 2, you use Creative Cloud and Firefly to instantly create all the legally safe content you need for those topics. Step 3, you use Experience Cloud to publish and measure the results.
It closes the loop.
Completely, from idea to analysis. It's a hugely powerful story for an enterprise CMO. And that $1.9 billion all-cash deal was easy for them to swallow with their, nearly $8 billion cash pile. A real power move.
Okay, so the strategy looks solid, but we have to talk about the risks. The market isn't pessimistic for no reason, and these risks are real.
They are. We've got regulatory issues, serious competition, and some governance questions. Let's start with the big one, the DOJ lawsuit.
This one could directly hit that recurring revenue stream.
It could. The Department of Justice sued them in June 2024. The allegation is that Adobe is trapping consumers in their subscription plans using deceptive design or dark patterns.
It's about how hard it is to cancel, right?
Yeah.
And those surprise termination fees.
That's the core of it. The annual paid monthly plan. People don't realize that if they cancel early, they get hit with a fee for 50% of the rest of the contract. The DOJ says that isn't disclosed clearly, and the cancellation process is a maze.
So what's the risk here? What's the worst case outcome?
A settlement could force them to implement a simple click-to-cancel button. No more phone calls, no more chatbots, just one click.
And if you remove that friction,
You could see a short-term spike in churn. That friction, honestly, it's a retention tool. If you take it away, that beautiful, stable ARR growth could take a temporary hit. It's a real quantifiable risk.
then there's the other lawsuit, the securities class action over the failed Figma deal. This one is more about trust in management.
It is. The lawsuit claims that management basically misled investors. They were publicly calling Figma just a little point product, while internally, documents apparently showed they saw Figma as an existential threat.
And the proof was the price they were willing to pay, $20 billion.
50 times Figma's revenue. When that price was announced, the stock cratered 17% because the market suddenly saw how scared Adobe really was.
What's the lasting damage from something like that?
It just puts a question mark over management's credibility. When they come out and say, don't worry about this new competitor, investors are now going to be a little more skeptical. It adds fuel to the bear case.
Okay, let's talk direct competitors. The Canva factor is huge.
It is. Canva owns the easy-to-use, consumer-friendly design space. And the threat is that they're moving upstream. Canva for Teams is targeting the same marketing departments that Adobe wants to sell more seats to.
And they're even getting into document editing, which threatens the document cloud.
They are. And Adobe's defense is Adobe Express, their own web-based competitor to Canva. And it's getting traction. Adoption was up 84% in the education and small business markets, so they are fighting back.
But it's a fight they have to have.
And it probably means more discounting and free tiers in that lower end of the market, which can put some pressure on average revenue per user.
What about in video? Premiere Pro used to be the undisputed king.
It's still dominant in Hollywood and big studios, but Blackmagic Design's DaVinci Resolve is a serious threat.
Because the base version is free.
A very powerful professional-grade version is completely free, so it's capturing the next generation. The YouTubers, the independent filmmakers, the pipeline of new users who grow up on Premiere Pro is getting smaller. It's a slow-burn threat, but it's real.
And finally, governance. There seems to be a conflict here. The company's buying back stock hand over fist. But what are the insiders doing with their personal money?
It's a good question. The company, led by the CFO, is signaling massive conviction with the buybacks. But the CEO, Shantanu Narayan, has sold about 172,000 shares since 2021.
Now, to be fair, a lot of that is automatic sales to cover taxes on stock awards, right?
A lot of it is, yes. But here's the yellow flag for an investor focused on governance. Even with the stock supposedly so cheap, there have been basically no open market purchases by any senior executives.
If they really think it's trading at a huge discount, why aren't they buying more themselves?
It's a fair question to ask.
And there's one last risk, related to AI, a congressional inquiry.
Yeah, the House Judiciary Committee started looking into AI censorship in March of 2025. They're asking if Adobe is tweaking its AI algorithms to reduce bias in a way that might actually suppress legal speech.
It's a tightrope to walk.
An incredibly fine line. Their whole enterprise mode is built on safety, but the creative community wants total freedom. Trying to please regulators and corporate clients at the same time is a major operational risk.
All right, so we have this incredible business facing some very real headwinds. Let's put it all together and talk about valuation. What is this company actually worth?
First, we have to remember why the valuation changed. From 2015 to 2018, during that big cloud transition, Adobe was growing revenue over 20% a year. The market paid a huge premium for that growth.
And now growth is in that 9–11% range. It's maturing. So the 40x PE multiple is gone. But should it be down at 20x?
That's the billion-dollar question. So we looked at it through the lens of a value investor like Warren Buffett. We focused on owner earnings, the real durable cash the business generates.
And that means looking at two things: the quality of the business and the price you're paying for its cash flow.
Exactly. For quality, the best metric is return on invested capital, or ROIC. How much profit do they make for every dollar invested in the business?
And Adobe's number is?
It's a phenomenal 35.27%. Now you compare that to their cost of capital, their WACC, which is about 8%.
So for every dollar they invest that costs them 8 cents, they're generating over 35 cents in profit.
That massive spread is the clearest sign you can get of a wide, durable moat. This is an elite business, full stop.
Okay, so the quality is elite. What about the price?
We use free cash flow as a proxy for owner earnings. That's about $9.74 billion a year. The whole company's market cap is around $144 billion. So you're paying about 16 times owner earnings.
A business with a 35% ROIC growing at 10% for 16 times cash flow. That sounds cheap on its face.
It's a massive discount to what a business of this quality would normally trade for. The pricing just doesn't seem to line up with the operational reality.
You know, this kind of valuation disconnect, it's exactly the kind of thing we're trying to track on a macro level. It's actually a good moment to mention for anyone listening who wants to track total market temperature. You can search and download the iOS app Buffett Indicator from the Apple App Store. It can give you some of that broader context.
That's right. Having that macro view is critical. So let's take all this, the quality, the growth, and run it through a conservative discounted cash flow model, a DCF, to get an actual intrinsic value.
And you were conservative with the assumptions here.
Very. We used a WACC of 7.96%. And for the terminal growth rate, that's the growth rate we assume forever into the future, we used just 3.0%, barely above long-term global GDP. It's a very low bar.
Okay, so with those conservative numbers, what does the model say the stock is worth?
The intrinsic value per share comes out to $626.51.
Wow. Okay. So the model says it's worth $626, and it's currently trading around $343. That implies an 82% upside. That's not a small mispricing.
It's a chasm. But this is the most important part. We also ran a bear case scenario in the model. We wanted to see what the stock is worth if the bears are totally right.
What did you assume for the bear case?
We assumed 0 revenue growth for the next 5 years, 0, and then a tiny 2% terminal growth rate, as bad as it gets.
And even in that doomsday scenario, the intrinsic value is?
It was approximately $365 per share.
So let me get this straight. The stock is currently trading at $343, which is below the theoretical value of the company, even if it never grows again.
That is the punchline. The current market price is pricing Adobe as if it is in permanent decline. Any growth at all, even the 5% they might get if churn ticks up, let alone the 10% they're guiding for, is pure upside for an investor at today's price.
That is a fascinating asymmetry. Okay, let's wrap this up. Let's summarize the key takeaways from this deep dive on Adobe.
I think there are 4 big ones. First, the whole story about AI killing Adobe just isn't supported by the data. They are growing at double digits, and they found a smart way to monetize AI through generative credits.
Second, their moat is real. And it's not just about features, it's about that workflow lock-in, and critically for big companies, that IP indemnification. It's a business moat, not just a tech moat.
Third, the financial quality is just top tier. You've got 89% gross margins, 35% ROIC, and a torrent of free cash flow that they are using to aggressively buy back their own stock.
And fourth, and most importantly, the valuation. At 20 times earnings, it's being priced like a no-growth utility. That creates a huge margin of safety when you compare it to a conservative intrinsic value of over $600 a share.
Which brings us to our final thought for you. We know the DOJ lawsuit is a real risk. It could force that click-to-cancel feature, and that might hurt growth for a little while.
But think about the price you're paying. Even if that risk happens, even if it knocks their growth rate down from 10% to, say, just 5% for a year or two, you are still buying the company today for less than its theoretical no-growth value of $365. How much safer can an investment get? This company is just so much more robust than its stock price is giving it credit for.
A great way to end it. And remember, all this analysis is based on public information, and it's for educational purposes only. It is not investment advice. Please do your own due diligence. And if you want to hear more deep dives like this, you can join our Deep Value Club membership or subscribe to our channel, Deep Value Investing, on Apple or Spotify podcasts.
We'll see you next time.